This is InvestTalk. Independent thinking, shared success.
Hi, calling today about McKesson Company, ticker MCK. I'm curious if you can shed some light on why this healthcare company is doing better than the other ones, even though there are supposed tariffs coming in. Curious if I should sell out of this. A bit worried since earnings is in about a week. Let me know your thoughts and what you would do with this company. Thank you. Bye.
McKesson Corporation, ticker MCK, is a healthcare services and information technology company. They specialize in pharmaceutical distribution, in medical surgical supply management, and all sorts of technical solutions for healthcare companies and healthcare providers. Now, it is a fairly large company, about $88 billion market cap. It's performed very well in the past year, up 33.68%. In the past year, up 16.49% in the past 3 months, up 24.05% year to date. And if you look back, going the past 6 years or so, it's outperformed its industry every single year, and its years of underperformance relative to the S&P 500, very minimal, with the most being 3.7% underperformance in 2019, but under 1% underperformance in 2023 and 2024. And its revenue growth is pretty stable and also solid, 7.6% on an annualized basis. Its margins, small but consistent, between about 40 basis points to 1.2%. So really what you're getting here is a lot of growth and not a lot of margin expansion. Now, they're trading at about 19 times forward-looking earnings, which is the high over the past 5 years. But the reason why this company is performing well is a successful strategic acquisition on one part, its contribution towards the distribution of GLP-1s, what has been a very growing market in the past year, 2 years, and really just a robust financial performance, as well as, like I said, that consistent revenue growth. They only have about $7 billion in debt, no short interest out there, or there is short interest out there, but not a lot of short interest, about 1.53%. And their dividend yield is small, but consistent, again, around 40 basis points, pretty much where it's been over the past 5 years. And they buy back shares. So they are as well floating that share price with their share repurchase program. They went down from 160 million shares in 2020 to about 125 million now. All the while, their cash flow has been steady. So this is just a consistent, solid business. We like it. It is a little expensive. We own it for our clients. We're certainly not buying any more of it right now, but we are still holding on to it. And it's had robust performance to justify that. So that is McKesson Corporation, ticker MCK. All right, let's get back to answering more of your questions. This one from the YouTube channel over there in the comment section. While you're over there checking out our videos, if you want to leave a question in the comment section, we get to those as soon as we possibly can. Or maybe you just want to say hi, we like that too. This question is about ticker XBB. It says, in your opinion, is a bond ETF such as XBB a good place to park money if you anticipate a market correction in the near term? Well, taking a look at XBB, what it does is it tracks a market cap valuated index that specifically invests in US denominated corporate bonds with a credit rating of BB or its equivalent based on an average of 3 main things. And so taking a look at this, let's scroll down a little bit here. Its expense ratio is about 20 basis points, so I'd expect it to just be US corporate bonds. About 80% of its exposure, this is again probably by revenue, is the United States. Taking a look at its long-term distribution yield, about 6.48%, so higher than you're going to get from money market funds or from short-term treasuries. So if you're looking for a little bit of yield while parking your cash in the short or medium term, this gets you some pretty solid returns from that respect. Coupon rate about 5.84% is where they currently are. The rated average life, or the effective duration, is 3.3 years. So it tends to be on the medium end of the spectrum. And so if you expect rates to go up in the near term, you expect rates to be higher, not the Fed necessarily pushing them higher, but the market saying, I don't know, United States government, you're taking on too much debt here, which is certainly a possibility. We do have a lot of debt. Well, then given that the duration is about 3.3, it's going to be more exposed to and more interest rate sensitive than something with a shorter duration. In fact, it has only medium duration bonds because the maturity of the bonds here at the minimum have to be about, looks like 18 months. For the past 3 months, it's up about 26 basis points. Year to date, it's up about 1.76%. 1 year, it's up about 7%. I think this is an interesting question because for a lot of people, they are scared right now. They have elevated cash positions. Hopefully, they're not all cash, but they have elevated cash positions. We, in fact, for our strategies, have elevated cash positions as well. But I think with a fund like this, although it is inexpensive, it invests in the US, I'm a little hesitant to park money here in the short to medium term, just because of the duration risk that you see with something that has a minimum of 18 months in terms of duration and an average duration of about 3.3. And so the risk here is, I already mentioned it, you could potentially have a situation where you are on the wrong side if rates in the market tend to lend higher, because the dynamics of bond pricing is such that as rates go up, current issued bonds prices go down because new issued bonds have higher rates. And so my suggestion would be, if you want to hold cash on the sidelines, probably want to reach for something with a shorter duration, stay on the shorter end of the curve. You will get less yield here, but you will also likely have a little bit less duration risk, interest rate specific risk, and still staying in the investment grade bonds is probably a wise choice to make as well. That is XBB, the Bond Blocks BB rated USD high yield corporate bond ETF. In these trying times, being in high yield bonds, also known as junk bonds, and being in the longer duration side, probably not a good idea. Now let's keep things moving and play another caller question now.
I was just wondering, I took some profits and have been sitting on maybe 35% of my portfolio in cash, and was just wondering, when do you think would be the best time to consider putting that back into the market? Should I be slowly doing that now? Should I wait till later in the summer? Just whatever advice you can give me on that, I would appreciate. Thank you.
So it's difficult to give you a direct answer to an important question. And that is because I don't know anything about you. I don't know how much of your portfolio is in cash. I don't know how old you are, which means how long your time horizon is. I don't know what type of account you have. And so I'll give general advice here. And so I have said over the past months and more recently that at KPP, our strategies currently have higher elevated cash levels because in times of market volatility, you benefit from being able to take advantage of those big downward movements that become more possible. And so, let's assume that you have more than an elevated cash position. Let's say you have more than 50% of your portfolio in cash. Well, if you have a long time horizon, it makes the most sense for you to reinvest in the market while the market is dipping. The reason being that if you pull out on a chart of the US market over time, it in the long run moves upward, and there is a higher probability that it will move upward the longer your time horizon is. Then you'll have a positive investment experience. And I talked to a client about this today, in that just because the market is down does not mean there is not a possibility of positive performance. If the market is down 5% in a year, you can certainly have positive performance. If the market is down 20% in a year, there oftentimes is nowhere to run and hide. But in general, all of this uncertainty, all of these market fluctuations, all the volatility doesn't mean there aren't any opportunities out there. It just narrows the opportunity set a bit, meaning that the rules by which you invest for companies with strong balance sheets, for companies with robust revenue growth, for companies with strong margins, just has to be more strict in this type of market environment. And so overall, I would say if you took some profits, which you should certainly do all the time, regardless of if the market is moving the way it has over the past month or so, the best time to start to reinvest is now. Not by fully investing all of your cash in once, but by dollar cost averaging or value cost averaging back into the market, so long as your time horizon is long enough to take advantage of the benefits of long-term investing. Very, very important question. Thanks for the call.
We appreciate you watching.
Don't forget to like this video and subscribe to our channel for more content.
Let's go to John from San Jose, who has a question about Booking Holdings. Do you own it or are you looking to buy it?
Yeah, I was thinking if this is the right time to get into this stock. It has had a very spectacular run in the last 2 weeks, in spite of uncertainty about the economy. So I was a bit puzzled. The stock has gone up very fast, and is this a good time? What's your take on this? By the way, I love your show. Appreciate all of what you do.
Well, thank you. This is a good question. So Booking Holdings, it is a travel company. So they run Priceline, Booking.com, Kayak, and Open Table. So not just travel, but dining as well. And it had a pretty strong past couple weeks on the back of earnings on April 29th, which showed pretty robust revenue growth, especially from their international segment, right? If we click on this right here, we can see that the earnings per share was 24.81 compared to a consensus of 17.37, a 42.9% surprise on the top line or on the bottom line number. And so that has propelled the company forward over the past couple weeks. The price up from about 4,400 to 5,185, I think 5,191 is where it closed today. And so I think that there's a little bit of concern here, understandably, that although you see, again, the robust international travel really pushing those revenues forward, is what would it look like on a forward-looking basis if the economy continues to deteriorate, if things become more expensive in our everyday lives, which therefore makes it more difficult for us to travel? We did a story last week about how more and more people are not taking summer vacations, how more and more people are doing what they call staycations. And so, on a forward-looking basis, I think there is a lot of risk here, especially with this recent run-up. Now, that being said, it's still trading below its 5-year average, trading about 23.1 times forward-looking earnings compared to 25, but well above the low of the past 5 years. And so if you have economic deterioration, you may have a year like 2021, where it underperforms the market by 20%. Or 2020 when it underperforms the market by 7.8%. And so for me, especially on this rip, I wouldn't be looking to buy here. We should get some more clarity, in the next couple weeks, in the next month, about what consumer spending looks like in the wake of tariffs, right? You have to remember that we were getting a lot of the data we got was March data, it was Q1 data before the announcement of what this was going to look like. And so for now, I would hold off. I'd keep it on my watch list. It's a solid company, obviously, when travel is robust. Not necessarily sure that's going to be the case moving forward. That is Booking Holdings, ticker BKNG. Let's drop in another fresh InvestTalk listener question now.
Hi, InvestTalk. I was calling in with a question on the company Intuitive Surgical Incorporated. The symbol is ISRG. And wanted to get your opinion if this would be a good stock to get into and what the outlook would be and what a good entry point would be too. So if you think it's a good one, thank you for your show.
Alrighty, so let's take a look at Intuitive Surgical Inc. That is ticker ISRG. It is a robotic-assisted surgical solutions company. And so they operate through 3 segments. Their services, which I imagine is ongoing subscriptions, their systems selling the initial products, and then instruments and instruments and accessories. Now, it is a fairly large company, right? About $194 billion market cap. It's got pretty much no debt, $146 million in debt. Their cash flow has improved pretty sustainably, I would say, not too fast. Their profit margins had dipped in 2022 and 2023, but since recovered in 2024, right? You see their net margin hitting a peak in 2021, about 29.9 times. In 2019 of 30.8 times, dipping down to 21 in 2022, but growing again pretty robustly. The revenue growth, solid, 13.3% on an annualized basis, though a lot of that in the back half of this 5-year sample. Now, one thing that is striking me is it's trading at 64.6 times forward-looking earnings, trading at 11.1 times price to book value, trading at 70 times cash flow. So certainly a little bit expensive, I would say, but still, from a relative strength basis, it's performed pretty well. It's up 39.45% in the past 52 weeks, albeit down 10% in the past 3 months. And so what this company does with its Da Vinci surgical system, my sister is actually a surgeon, and she has used some of these robots and she loves these robots. But if healthcare costs, or rather healthcare revenues, start to fall, well, then companies like these aren't going to see the investments that they have seen from hospitals over the past 5 years, right? Its innovation has been great. My sister loves that system. Its expansion has been great as well, but these potential challenges from tariffs, where the cost of producing these robots and repairing these robots becomes more expensive for them and more expensive for the hospitals, with macroeconomic factors, as I mentioned, give it potential risk to the downside, especially for a name that is this expensive. And then so, with that being said, I think that for now, given this run up, given how pricey it is, I would stay away from it for now, although it has performed pretty well over the past 3 years. A lot of risks out there for an expensive to produce and repair product that is Intuitive Surgical Inc., ticker ISRG. Looks like we have another live call, Jacob from Santa Rosa, asking about gold and listening on AM 1220. You there, Jacob?
Hi, yeah. I had a question about silver as it relates to gold and its recent run-up. I noticed recently that the gold to silver ratio has gone past 100, which from my understanding has only happened about 3 times in the past 100 years. Okay.
And so is your question related to, why? I mean, let's dive into that. So we've seen over time, over the past year or so, really year and a half or so, that there has been a divergence from this traditional relationship between gold and silver, where gold tends to climb and appreciate in price pretty quickly, and then silver tends to track that, in a more stepwise way. And so over the past year or so, what you've seen is really a disconnection, a dislocation from this relationship. And I think that has to do with what they really are used for, right? Gold is a safe haven asset. It has been seen as one for some time at this point, right? The US government used to mark their or really control for the price of the dollar relative to gold. A lot of countries used to do that for their currencies as well. And so gold tends to respond faster to inflation and monetary policy and fiscal policy as well. It also is far more, because of this, liquid in terms of its trading through ETFs. Their ETFs are more liquid because of the volume, and the physical gold is more liquid than physical silver as well. And so in uncertain times, like we have now, high levels of uncertainty, people tend to flock towards gold. Now, silver, on the other hand, doesn't really offer that kind of historical safe haven levels, or at the same levels. It has more of an industrial use. And so over time, over the past couple of years, what we've seen is that divergence is likely due towards silver being more of that industrial metal, and having those industrial uses such that when the economic outlook is weak, the price of it doesn't appreciate to the degree that gold does by its safe haven precious metal nature. And so that's something we've seen, and something I would expect to see continuing moving forward. That is the relationship between silver and gold. A great question. Thanks for calling, Jacob. Now, it is earnings season. Feels like it's always earnings season at this point. And one interesting note was from Ford, who suspended its 2025 earnings guidance due to tariff uncertainty, saying that tariffs may cost it as much as $1.5 billion in adjusted earnings before interest and taxes this year. Its previous EBIT forecast was $7 to $8.5 billion, and it didn't factor in those tariffs. And so given that the potential for their input prices or the input materials to have a cost inflated due to importation costs, well, it makes sense for them that they would want to revisit that. Earnings per share for Ford came in about 14 cents, beating estimates by 2 cents, but net income fell by 471 million, which is indicative of something we've seen across the auto industry. And frankly, one of the reasons why we tend to stay away from automakers, because it is a difficult, costly, and sometimes brutal business. They and the industry as a whole saw the revenue fall for Ford. It was 5% year over year to $40.7 billion, still beating expectations. But I think the big story here is the thing that I mentioned at the top, which is tariffs could add $2.5 billion to costs this year, especially because so much of their supply chain runs through Mexico and runs through China. A lot of the manufacturing of these cars tends to hop back and forth across borders. Across the industry, Trump's 25% auto tariffs are estimated to add potentially $100+ billion in industry-wide costs this year. GM, another big automaker in the US, expected to see a $5 billion hit. Stellantis also withdrew their recent guidance as well. And so, I think this is important to note because oftentimes when we're thinking about this, we do have specific auto tariffs. So it makes sense to understand the ramifications for that industry broadly. But just with our ISRG question, it's important to see how all of these things combine to affect the cost, not just to consumers, but to companies as well, therefore affect their stock price. And this trend of, should this continue moving forward, this trend of revisiting and pulling back earnings forecasts is likely to continue and be more prevalent for the rest of the year. Now, real quick, let's try and fit in another caller question from our InvestTalk YouTube channel. This one is SPYI and QQQI. And the question is, what do you think of income ETFs SPYI and QQQI? SPYI is the NEOS S&P 500 High Income ETF, and QQQI is the same thing, but for the NASDAQ 100. It's for the Qs. And both of these funds are aiming to boost income for investors. They're ETFs. They're both ETFs by doing what we do with one of our strategies, Equity Income Plus, and that is writing covered calls. And so this approach is to hold underlying assets, right? That's the covered part. Write calls on them, bring in the premium income. And, should the calls expire worthless, well, then you just keep the premium income. Should the price go higher than the level of the call, well, then your stock is going to be called away, or there are various things you can do to close it out if that becomes close. And so the big point of this being, you can invest in the market, you limit some of the upside, but then on a recurring basis, you're also seeing premium income coming into the fund. And so SPYI, just as an example here, has a yield right now sitting about 12.92% is the long-term distribution yield for this fund. The current dividend yield is about 1.35%. So a lot of that income is contributing to the yield that you're seeing in this fund. It's about 68 basis points in terms of its management fee. So a little bit expensive, I would say, for a fund that is investing in US large cap securities, but they're making their money from that covered call approach. Now, NEOS's version of the same fund with the NASDAQ 100 is also 68 basis points with a little bit higher long-term distribution yield, about 15.17%, and a lower dividend yield of about 0.77%. And so, I think that covered call strategies can be good strategies to implement if you are looking for income. But understand that, you are still exposed to the underlying. And so when you're focused in the NASDAQ 100, you tend to be a little bit more concentrated, S&P 500, a little bit more broadly diversified. That's why you're seeing year to date with some of this downward market movement, it's outperforming because of that premium income that it's receiving. So in times when the market's moving down, these tend to be pretty solid investments. Getting that income help you match those liabilities over time. So good ideas. We run a strategy ourselves. That is SPYI and QQQI. Looks like we have a third live call. James from New York. Everyone's name starts with a J today. That's interesting. Well, James from New York, you have a question about Qualcomm. Do you own it or are you looking to buy it?
I own it, and I'm wondering if these levels are good for a accumulation for maybe a 3 to 5 year or even longer than that type of holding in Qualcomm?
That is a great question. So QCOM is Qualcomm Incorporated. It is a semiconductor company. Full disclosure, we own it for clients in one of our strategies as well. And it's been beat pretty brutally over the past year, down 22.38%. In the past year, down 9.23% year to date, down 20% in the past 3 months. Its revenue growth rate over the past 6 years, pretty solid, about 10% on an annualized basis. Its margins, very solid, upwards of 25% for the past couple years, projected to be about 30% this year. And so, as you'd expect with a lot of tech getting beaten down, certainly the semiconductor side, remember semiconductors tend to be a cyclical business, Qualcomm is hurting. Now, for a 3 to 5 year time horizon, I think Qualcomm is a pretty solid investment because of how intertwined it is within the semiconductor space and how critical it is towards the US being competitive in the production and utilization of semiconductors, particularly when the largest amount of capex has been towards the artificial intelligence secular growth theme. And so if you can stomach the volatility, remember these tend to be very volatile, especially in times of economic uncertainty, I think that reaching for it at these levels is reasonable. One important note as well is we do have the sectoral tariffs coming on the horizon as well. So something to be certainly concerned about if you are thinking about going all in on Qualcomm. I would not advise that. So just wanted to point that out as well.
Learn more about our services and insights by visiting investtalk.com.
Hey, Justin, how's it going? I just wanted to give you guys a call and thank you for all that you guys do. I'm a fellow financial advisor and longtime listener, and really love the show. So, question about Shopify. I know it's a growth stock, and I obviously understand the trend towards value. What is a good entry point? Do you guys own any Shopify in your portfolios, and how you guys feel about the stock long term? Thanks for everything. Look to hear your answer on the podcast.
Well, we don't currently own any Shopify. Shopify is a cloud-based e-commerce company, so they pretty much have a hand in a lot of small and large businesses in terms of the selling and retail and commerce side of the business. Now, one of the issues I would say with Shopify, and that's something we should get some guidance on when they release earnings on May 8th, is the investments that they've made in AI from their side that haven't really borne fruit in terms of efficiency or kicking down costs yet, mean that going forward, the margins that they've been able to garner are likely to be smaller. Right? We're already seeing 22.7% margin projected to fall to 17.5%. This is a warning they gave us as well. And this is one of my big problems with the business, right? Is margins are all over the place. And so even though you're seeing 42.2% growth, which may or may not justify at 16.9 times forward-looking earnings, you stand to see, again, this is according to them, and they should give us more clarity this week, likely smaller diminishing margins, at least in the short term, because they're spending a lot of money in order to grow their offering and service those businesses with their internally within their systems and the AI they're implementing in their systems. And so for me, given all that uncertainty around that, given the fact that they also are making money by processing orders, should consumer spending ability fall? Well, that's kind of a double-edged sword in terms of not just top-line revenue growth falling, but margins contracting as well. And so, given that, I just think it's not justified in terms of its expensive nature. It's 60.9 times forward-looking earnings. It's down 11.2% year-to-date, down 22.1% in the past 3 months. So for now, I would stick away from Shopify. Certainly, my general advice is do not buy anything within the 2 weeks surrounding earnings anyway, but we should get more clarity this week. That is Shopify, ticker SHOP. Now, before we head off into the night, I guess, my brain already thinking it's Friday, I wanted to briefly talk about the newest tariff threat that the president has proposed, which is a 100% tariff on films made abroad, claiming other countries are drawing filmmakers away and Hollywood is dying fast. Now, industry leaders are warning that the move would be pretty devastating. A lot of movie production has moved outside of the United States for cost reasons, for various reasons. And so studios, but also cinemas that are already struggling coming out of the pandemic, could suffer as well. My first question is, how do you enforce this? How do you monitor and charge for this service of just producing a film in a location outside the United States? It would affect a lot of movies. It would affect, Harry Potter, also, those types of movies that are produced outside of the country. And that's why you saw some reaction to the stock prices of Apple, to Netflix today, a lot of those studio names, because executives are understandably weary of what this could mean for their costs. My larger concern is on a broader level. Up until this time, there really hasn't been a tariff on services historically. Do we want to open the can of worms, considering that services is the largest part of our economy? Certainly an important thing to track, an important thing to see, an important thing to watch. I'm Luke Greer, and this completes another InvestTalk program. Justin and I thank you for listening or watching. I encourage you to tell your friends and family about our free podcast, which is available on iTunes, Google Play, Spotify, and over there on YouTube as well. Remember, we can help you better understand your portfolio dynamics, calculate your investor risk number, build a full financial plan, build a custom index, optimize your 401k. No matter what you need, it all starts with a portfolio review over on InvestTalk.com. Independent thinking, shared success. This is InvestTalk. Good night.